So here's some theoretical results I've had using 17 years worth of data, starting with $100,000. The average rate of return is the following. Now, this doesn't mean I lost money. It means I had 100,000 plus 25%, so it's 125. And so, worst case was gaining 125%. Best case, 164, which would be $264,000. If you average all the monthly gains and losses, this model makes 7% per month. Here's theoretical results. Now I tried it with $10 million, and you notice the average gain dropped to 4.7. And the idea is that if you have a little bit of money, you can move it around really fast. If you have a lot of money, it's hard to get it in the market and out of the market because of the momentum, mass momentum. But this one still, for 10 million, it gained 20%, like 12 million. I think 80 was the high, 88, so it might have been $18.8 million. So it looks like very good results. This includes some of the black swans that I mentioned. Now, let me talk about actual results. There's talk the talk and walk the walk. Actual results for fiscal year 2016, I had 150 winners, 54 losers, 73.5%. That sounds pretty good, right? But what I say, the winners could be small, the losers could be big. Well, let's see what this works out to. Year to date, I'm up 40.41%, okay? And the blue line is the profit that I've made on a daily basis. I've not had a losing day this year, okay? The red line represents the S&P 500, because I trade the E-mini. First couple days, the S&P lost 6% in 10 days. Worst case, it got down 10%, and it's been struggling more or less flatlining in this particular case. Morris?
Speaking retired early.
What, miss you? No way. Now let me impose a trend line here. If I put a trend line, 98% correlation, and the Y value, the trend, the slope is 0.0089. Let me explain what that means, 0.0089. That means I gain almost 1% per day. So if you had $100,000, you would gain about $890 per day. Okay? So it looks pretty good. Well, here's a question. How do you judge how good that number is? Well, if you have your own personal retirement account and that's better, you'll say, it's good. If you're doing better, you'll say, oh, it's okay. If 95% of all financial data mining research appears to be flawed, how do you assess results? Let me tell you what happened on campus a couple of years ago. There was a faculty member who sat in on my financial data mining class, and there was a luncheon over at the Bayou building, and I said to the person, oh, by the way, have you done anything with financial data mining, having sat in on the class? And the faculty member responded, no, I'm going to leave it to the professionals. Okay? And it gave me a brilliant idea. I will compare the results I have with professional traders to kind of gauge how well this looks. And so what I did, there's a website called Barclay Hedge. I don't know if you've heard of Barclay Hedge. You go into Barclay Hedge, and there's 1,084 programs. Now what does that mean? There are people that trade the S&P E-mini and other commodities. I only do the S&P E-mini. They're called Commodity Trading Advisors, CTAs. They're from all over the world. They post their results onto this website. Hopefully they track business from what I understand. Now, there are a lot of columns here. I want to draw your attention to the year-to-date 2016 values. 53%, 38, 35. If you took my results from the end of February, 34.21, I would rank 4th out of 1,084 traders. Okay? Pretty good. So I've enjoyed working here. Okay. That's one website. Another one is called IASG, which is short for the Institutional Advisory Service Group. And on this one, we see 535 people that submitted their results. Of course, there can be an overlap between the two sites. I don't know who's done what, but just another site. There's the year to date. And at this point, I would finish 2nd out of 535. Kind of like Hertz, they're number 2 or something. So I'm really pleased with what I've done in terms of what these people that do it for a living. And finally, in conclusion, is it possible to time the market? And you think I'm going to say yes, I know. My response has 3 parts, okay? The first part, I think 15% of the time you can time the market, and it seems like I'm correct, that's 15% of the time. 5% of the time, I think I can time the market. I'm wrong, okay? But that's where you have money management so you don't get clobbered, and you apply that. And the other 80% I'm not sure. And the idea is maybe over time, as you discover more patterns, this number might decrease and pushed up there somewhat. So that's all I have at this point. Any questions? Yeah.
Where do you get the 15, 5, and 80 from?
I randomly made that up.
Oh.
That's a good question, and a lot of time, it's like fishing. You can spend an hour, 2 hours fishing, and I might have something going on my computer, I'm not paying attention to it, and then ding, 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 there might be a situation I look at and decide if I want to go in or not. But I don't have any good criteria for that.
Is there a way of taking into consideration other factors, such as something like this stuff that happened in Paris, or
Oh, absolutely.
fundamentals?
Well, let me address that. And
I have two parts. So.
okay, the first part in the market, there's historical things that could be going on now in terms of either terrorist type activities or whatever. Financial reports come out usually at the end of the market close. So what I do is I want this to be pure mathematical based, and as a consequence, I don't do anything outside of market hours, which are like 8:30 in the morning to 3:15. Okay, so you can't eliminate it totally, but at least try to reduce that aspect of that. Did you have a follow-up question?
Yeah, but is this paper money or did you make money?
This is all real money, what I just showed you.
It's a real money?
Yeah.
Lunch is on you.
Lunch and dinner. Tom?
Well, time series analysis is an old art. And if the market is actually a random time series, you agree it would be impossible to predict from historical data. Norbert Wiener actually proved that mathematically, right, many years ago. He was interested in other problems. But. So do you think, how much of the market is random time, forgetting fundamentals in specific cases, is a random time series, which would be more or less unpredictable? How much is trend? How much is because in this country the trend has been good even through the Depression. Right? Do the quants make any such calculation, or they say, well, we just do our math?
Let me put it this way. Rephrase it. Why does this work? Okay. One of the technical analysts says he calls this lies that work. Okay. And the idea is that if I told you that if you buy tomorrow at 9 o'clock and sell at 9:30, you'll make a lot of money. And if everyone told everyone, that would happen, self-fulfilling prophecy. So one of the trends that's happened over the years is I think there's a move away from just pure investment to more of this trading Wall Street has hired 2,000 of these quants, which are people like with physics degrees or some technical degree.
Harrison, you hearing this? Good.
And so if enough people apply it, then the nature reality will adjust accordingly to what's happening.
Good point, very good point. So now then, it's not a random time series, it's being driven, right? Like the weatherman who sees the group out in the desert bringing the firewood in, and he predicts
Oh,
this is
yeah.
gonna be a cold winter.
Yeah, and they're
So,
really,
but now you're injecting a stimulus. It's more or less arbitrary, yes.
and here's another factor.
Isn't that what speculators do on the large scale, to some extent?
Oh, I don't know what they do. But another thing is, I know there's quite a few faculty here. I don't assign seating, and I assume quite a few of you do not assign seating. And you probably notice the pattern after the first couple of days. Every student kind of has their own little terrain turf, they sit there. So I think in certain ways, people are very predictable in terms of the stock market, the greed and fear. And so I really don't do financial data mining. What I do is model behavior of people. Okay, that's the way I view it. And it seems like it's been working well so far. Rup?
Oh, yeah, so is it fair to assume that this model ignores the dividend-bearing shares?
There's no, all I'm trading is the S&P E-mini.
Okay.
And one reason I trade the S&P E-mini is it's an aggregation of 500 stocks. And going back to what Said raised earlier, is you want to eliminate all this extraneous events happening. If I bought in, let's say Microsoft, something at Apple could trigger something at Microsoft, so you want to avoid noise from adjacent items. Also, if you buy Microsoft and something happens to Bill Gates, the stock might go down. So by using the aggregate, the S&P 500, the news tends to not penetrate the price movement as much.
So you control for those compounding effects that could affect.
Yeah, I try to eliminate or reduce as much as possible. That's my experience. Question over here?
So in your model, do you consider the volume? Because sometimes the low
Yeah.
volume can generate a false signal for your indicator.
I don't pay attention to volume. You would?
So how would the AI crash or shock the market?
There is a problem with AI, like they showed an example of the Amazon, and 2 AI programs were trying to buy a book, and it went up to like $23,000, and it's bad software. There is the possibility that if I said the secret sauce is 2 moving averages crossing, everyone did it, all of a sudden that would dilute the effectiveness of that, okay? That's the best answer I can give you at this point.
The second one was undervalued stock.
Oh, I don't look at stock, so I don't even look at undervalued. I'm strictly timing the market,
Right.
okay?
Look at the basket.
Yeah.
So what if I make a lot of money, but all the good business are not making money, so I have no place to get goods and services after I'm rich?
Well, another thing, as I mentioned, not only am I looking long, I'm looking short, so if you find a bad company, you can short that company.
I see.
This is something, Keith, I see.
Your protective stops, are they static or do they move up as the?
Like a trailing stop?
Yeah,
Yes, trailing.
okay. Still 5%, but they creep
5
up.
points.
5 points.
Other questions? If not, thank you all very much.
Thanks a lot.